Your brokerage account can look like a simple place to invest while hiding the decisions that determine what you own, what you owe, and how much control you actually have. On one screen, the balance is green. On another, the application still contains ordinary-looking choices: cash or margin, individual or joint, invested or sitting in cash. Those choices are why these 7 brokerage account rules matter for every woman building wealth. By the end, you will know what the account does, what it does not do, what to check before opening one, and which single setting can quietly turn a straightforward investment account into a borrowing arrangement. You are not behind if nobody taught you this. The version of financial education many of us receive jumps from save money to start investing and treats the account in between like paperwork. But the paperwork is where ownership, permissions, fees, taxes, beneficiaries, and borrowing features begin. Consider an illustrative composite named Elena. She has an emergency fund, contributes to her workplace retirement plan, and recently moved part of a bonus into a new brokerage account. The transfer felt like progress. Her dashboard now showed a second place for long-term money, separate from retirement. But Elena could not answer 3 basic questions. What exactly did she open? What did the money inside the account own? And what rules had she agreed to when she clicked through the application? She is not careless. She did what many responsible women do when the system gives them fragments instead of a map. She saved. She contributed. She avoided making a decision she could not explain. Then the account interface made several different financial choices look like one simple action: open, transfer, invest. They are not one action. That missing map is what we are fixing now. Savings has a job. Retirement accounts have a job. A taxable brokerage account may have a job too, but opening one is not automatically the right next move, and the account itself does not create wealth. Before Elena chooses an investment, she needs to understand the structure holding the money. Start with rule number 1. The account is a wrapper, not the investment. A brokerage account is the registered structure that can hold investments. Depending on the firm and the account, those holdings may include stocks, bonds, mutual funds, exchange-traded funds, or cash that has not yet been invested. The account creates access, registration, statements, and record keeping. The assets inside it create the market exposure. That distinction sounds small until real money is involved. Someone says she invested in a brokerage account, and the sentence makes the account sound like the thing producing the return. An app displays one large balance, so deposits, cash, funds, gains, losses, and withdrawals begin to blur together. Then, a woman can believe she has made an investment decision when she has only made an account decision. Elena transferred money into the account, but she had not yet bought an investment. Her money changed locations. It did not automatically begin compounding, diversify itself, or become productive ownership. That is not an argument against holding cash. Cash may be intentional. It may be waiting for a planned purchase, reserved for a near-term goal, or left uninvested while the owner decides what risk she can actually tolerate. The point is precision. A funded brokerage account and an invested brokerage account are not the same thing. Once you separate the wrapper from the contents, several common mistakes become easier to see. Opening the account does not diversify you. Buying one stock does not create a strategy. A green number does not tell you whether the gain is realized, taxable, temporary, or meaningful after costs. A red number does not mean the account itself failed. It means something held inside the account changed in market value. The account answers one set of questions. The investments answer another. So instead of asking, "Is a brokerage account good?" ask 4 sharper questions. What role would this account serve? What would it hold? When might I need the money? What costs, taxes, and risks come with using it that way? Those questions do not make investing more complicated. They stop a financial product from making the decision for you. For Elena, the first breakthrough is not choosing a fund. It is realizing that she has been trying to solve 3 separate problems with one click. Where should the money be registered? What should the money own? When will she need access to it again? The account answers the first. The investment choices address the second. Her goals, timeline, emergency reserves, debt, and ability to withstand a market decline shape the third. This is where the title of this video becomes practical. Every woman building wealth should know these rules because understanding the account is broadly useful even when opening one is not the right move yet. Knowledge is the universal part. Suitability is conditional. That difference protects you from 2 bad messages at once. The first says brokerage accounts are only for people who already understand the market. They are not. The structure can be learned. The second says opening one is the obvious next step for anyone serious about wealth. That is not true either. A high-cost debt balance, an underfunded emergency reserve, an unclaimed employer match, a short time horizon, or a low tolerance for market losses can change the order completely. The goal is not to turn you into someone who speaks in market jargon. The goal is to help you see what each account does, whose name is on it, what it can cost, and whether it gives you more choice or quietly adds fragility. A balance tells you how much is there, ownership tells you whose it is, what it holds, what rules govern it, and what job it performs in your life. Keep that distinction close as we move through the 7 rules. And now, the first hidden risk appears. Brokerage applications can make opening an account feel fast and routine. A few screens, a few disclosures, a few boxes, and the process can feel almost administrative. But one of those boxes can change the mechanics of the entire account. It asks whether the account will be cash or margin. In a cash account, purchases are paid for in full. In a margin account, the brokerage may lend money against the account under the terms of the agreement. That can create interest charges, magnify losses, and allow the firm to sell assets when margin requirements are not met. Those are not two cosmetic versions of the same account. Elena thought her first serious decision would be which investment to buy. The more urgent question came earlier. Was she opening an account that used only her money, or one that could also use borrowed money? That is rule number 2. And it is where a routine-looking checkbox can quietly change the risk, cost, and control of everything that follows. Rule number 2 begins before Elena buys a single investment. She has to know whether she opened a cash account or a margin account. Those words can sit beside each other on an application like 2 routine settings. They are not. One means every purchase must be paid for with money already in the account. The other can allow the brokerage firm to lend against the account under the terms of the agreement. That missing variable is not investment selection. It is borrowing. Elena's strongest objection is reasonable. I do not plan to borrow, so why should margin matter to me? Because the account agreement matters before intention does. A feature you never expect to use can still change the rights attached to the account, the cost that may appear, and the firm's response if the value of the assets falls. In a cash account, purchases are paid for in full. In a margin account, borrowed money can increase buying power. That is the strongest case for margin, and it is real. An investor may be able to buy more than the cash balance alone would permit, but more buying power leaves out the variable that decides whether that power strengthens or weakens you. Who supplied the extra money? If the brokerage supplied it, the larger position is not fully yours. Interest may be charged. Maintenance requirements may apply. If the account value falls far enough, the investor may have to deposit more cash or securities. Under the agreement, the firm may also sell assets to address the shortfall. So one market decline can create 2 pressures at once. The investment loses value, and the loan attached to it does not politely shrink with the loss. Without borrowing, a falling asset may force you to wait. With borrowing, the same fall can force you to act. That is why the useful question is not, can margin help me buy more? It is, what happens if the market moves against me before I am ready? For a woman building wealth, choosing the simpler structure is not a lack of sophistication. It can be a refusal to let borrowed money set the deadline. If your rule is that you only invest money you already have, then a cash account matches that rule more directly. Elena goes back to the application and reads the account type again. This time, she is not asking which option sounds more advanced. She is asking which one matches the behavior she is actually willing to live with when the account is under stress. If the account is already open and the label is unclear, the next move is not to guess from the app design. It is to check the statement or account agreement and ask the firm to confirm the account type in plain language. That is the payoff of rule number 2. Do not choose an account by what it lets you buy on a good day. Choose it by what it can require from you on a bad one. Now, rule number 3. Ownership starts with the name on the statement. A brokerage account may be registered to one owner or more than one owner under the account agreement. Those labels affect how the firm records ownership, who can act on the account, how statements are issued, and how transfers may be handled. The hidden variable here is not the household's total wealth. It is account registration. Many households use one number to describe everything they have. That number may be useful, but it can hide the question a woman most needs to answer in a moment of pressure. Which assets can she identify, locate, and explain without relying on someone else's memory? That does not mean every account should be individual. It does not mean a healthy couple should hide money from each other. The strongest argument for joint ownership is also real. Joint registration can make shared access and shared administration easier when the account is genuinely meant to serve a shared purpose. But shared purpose should be visible, not assumed. Elena opens her latest statement. Instead of checking only whether the balance rose or fell, she looks for the account registration. Then she checks the account type, the holdings, recent activity, and the contact information. The statement stops being a scorecard and becomes a map. That shift matters because financial control begins with visibility. You cannot manage an account you cannot locate. You cannot verify ownership you have never checked. You cannot update a beneficiary you did not know was missing. And you cannot evaluate a fee, transfer rule, or borrowing feature if the only number you read is the headline balance. There is an important boundary here. An account registered in one person's name is not automatically protected from every creditor claim, court order, marital property rule, or other legal issue. State law and personal circumstances may matter. Individual registration can improve operational clarity. It does not create universal legal immunity. That distinction keeps a useful fact from turning into a dangerous promise. The statement can show how the brokerage records the account. It cannot settle every legal question about the property in every situation. So the practical move is not to assume protection. It is to build an ownership record. For each account, write down the institution, the account name, the registration, the owner or owners, whether it is cash or margin, and whether a beneficiary or transfer on death designation appears. Those fields reveal more about control than one household net worth total ever could. Then separate 3 roles that are easy to blur. An owner has rights under the account registration. A beneficiary or transfer on death designee may receive assets after the owner dies, subject to the account terms and applicable law. A trusted contact serves a different purpose. That person may help the firm respond to concerns such as suspected exploitation or difficulty reaching you. But being listed as a trusted contact does not make that person an owner. One form can contain several names. Those names do not all carry the same authority. That is the non-obvious part of rule number 3. Ownership is not a feeling, a household assumption, or the fact that you know the password. It is a documented structure with specific roles. A large combined balance can feel reassuring while hiding operational confusion. A smaller, well-mapped system can give you something the larger number cannot: the ability to explain what you own, where it is, how it is registered, and who can act. Elena can now answer 2 questions she could not answer when she transferred the bonus. She knows whether the account permits borrowing, and she knows how the brokerage records the ownership. But a correctly opened, clearly registered brokerage account can still be the wrong place for the next dollar. Before she funds it further, she has to test the priority nobody can see from the application screen. What financial obligation, protection, or benefit may deserve that dollar first? A brokerage account can be opened correctly and still be the wrong place for your next dollar. That is rule number 4. The account may be ready before your financial life is ready to prioritize it. Elena has already done the careful work. Her account is cash, not margin. The registration is clear. She knows whose name is on the statement. The transfer button is waiting, which makes the next step feel settled. It is not settled. The missing variable is sequence. What this dollar must do before it is allowed to take market risk. The strongest argument for investing it now is fair. Time matters. Money that remains outside the market may miss growth, and waiting forever for a perfect financial life can become its own expensive habit. But that argument has a limit. A possible future return cannot erase a bill with a due date, an interest rate written into a contract, or an employer benefit with rules attached to it. Investing sooner may improve one future. Sending the dollar to the wrong job may weaken the present so badly that you are forced to sell later. So the rule is not wait until everything is perfect. Nothing will ever be perfect. The rule is simpler. Do not invest money whose real job is to prevent a forced decision. Start with the date. When is the earliest moment this money may be needed? Not the vague answer. Probably not for a while. Put the actual need on a calendar. A known insurance deductible, a planned move, tuition, a car that is already asking for repairs, or a household supported by one unstable paycheck can change the role of the dollar. The deciding figure is not the brokerage balance. It is the time between today and the expense. Elena already has an emergency fund, but the label alone does not prove that the buffer fits her exposure. The useful questions are more specific. What expense could arrive first? How much cash would it require? How quickly could she replace that cash after using it? Money in a brokerage account may be sellable. That does not mean it will be worth what she needs on the day she needs it. If the market is down, access can come with a loss. If selling creates a taxable gain, access can come with a tax consequence. If she refuses to sell, the expense may move onto a credit card. This is the non-obvious mechanism. Insufficient cash does not merely create inconvenience. It can choose the timing of your investment sale for you. Next, put every debt obligation beside the transfer amount. The strongest version of the opposing view is also reasonable. Not every debt should be paid off before investing. A low contractual rate, an employer match, tax considerations, and a long time horizon can make simultaneous investing defensible. But debt is too broad to settle the question. The missing variable is the APR and the required payment printed on the statement. An investment return is uncertain. The interest terms on the debt are contractual. Elena does not need a slogan such as always invest or always pay debt first. She needs the figures on the same page: the APR, the minimum payment, the payoff terms, any employer contribution she would give up, and the amount of cash left after either choice. If the debt is consuming the margin she needs to remain stable, sending the next dollar to a taxable account can make her look more invested while leaving her less free. Now check the paycheck before checking the market. A workplace retirement plan may include an employer contribution tied to Elena's own contribution. The brokerage platform cannot see whether she is collecting the full benefit available under her plan. It only sees cash available to transfer. The deciding number is in the plan document, the contribution level required to receive the full employer amount. If Elena is eligible and below that level, the taxable brokerage account may be competing with compensation she has not collected. That does not mean an employer plan wins in every case. Vesting rules, plan costs, investment options, cash flow pressure, and personal goals still matter. It means the comparison must include the benefit before she declares the taxable account the winner. The same discipline applies to other tax-advantaged accounts. An HSA, IRA, or workplace plan may offer rules that fit a particular goal better than a taxable brokerage account. Or it may not. Eligibility, contribution limits, tax treatment, access rules, and time horizon decide the role. This is where many women are handed the wrong question. We are asked, which account is best, as though one wrapper can win every contest. Ask instead, which account gives this dollar the most useful job after cash needs, contractual costs, available benefits, taxes, time, and risk are included? That is the next dollar test. Elena writes 5 lines before she transfers anything else. What exact expense could require this money first, and when? What APR or contractual cost is already charging me for waiting? What employer contribution or tax advantage could I lose by sending the dollar elsewhere? How long can this money remain invested without being needed? What will I do if its market value falls before that date? Those 5 answers turn I should invest more into a decision she can see. They also remove the shame from changing the order. Keeping enough cash to avoid a forced sale is not fear. Collecting an employer benefit before funding a taxable account is not lack of ambition. Reducing a contractual cost before accepting market risk is not falling behind. The purpose of wealth is not to fill every account as quickly as possible. It is to increase the number of choices you can make without being cornered by a bill, a lender, an employer, or a market decline. And sometimes the correct transfer amount today is 0. Not forever. Not because investing does not matter. 0 can be a deliberate decision when another dollar has a more urgent job. You do not need an app to approve that choice. You need the figures that justify it. So before Elena funds the account again, she creates one visible order on paper. Protect the cash date. Measure the contractual cost. Collect the available benefit. Confirm the time horizon. Then decide whether taxable ownership receives what remains. If the dollar passes that sequence, the brokerage account may have a legitimate role as a flexible ownership layer, but the amount she transfers is still not the amount she ultimately keeps. Taxes, fund expenses, advisory charges, service fees, and transaction consequences can all sit between the headline return and the value that remains hers. That is rule number 5. Flexibility has a cost structure, and the next figure Elena needs is not what the account appears to earn. It is what survives after the costs. The number Elena sees on her dashboard is not the number she keeps. Between that green balance and money she can actually use sit 4 quiet claims: taxes, investment expenses, account charges, and paid advice. That is rule number 5. Flexibility has a tax and cost structure. A taxable brokerage account can give Elena access to investments without the same retirement age framework attached to many retirement accounts. That flexibility is real. But the screen usually leads with the easiest number to admire: the current balance. The balance does not show what survives every layer. If you have only been watching that number, you are not careless. You were shown a score before anyone taught you to read the rules underneath it. Start with taxes. Money contributed to a taxable brokerage account generally arrives after income tax has already been paid. That doesn't make everything inside the account tax-free from that point forward. Interest and dividends may create taxable income. Selling an investment can create a capital gain or loss based on the difference between the sale proceeds and the adjusted basis. The holding period matters because short-term and long-term gains can receive different tax treatment. Elena's strongest objection is reasonable. If I leave the money in the account, why would taxes matter yet? Because withdrawal is not the only event that matters. A price increase alone generally does not create a taxable capital gain because no sale has occurred, but dividends or interest may still be taxable when paid, even when they are automatically reinvested. And when Elena eventually sells, the tax result depends on basis, holding period, and the transaction she made, not on whether the cash ever reached her checking account. The missing variable is the taxable event, not the withdrawal. Now add the cost stack. One layer may belong to the account, maintenance, transfer, wire, closing, or other service charges, depending on the firm and account. Another belongs to the investment. A mutual fund or exchange-traded fund can carry operating expenses that reduce the return inside the fund rather than appearing as a separate monthly bill. A third may belong to advice or management, including a fee based on the assets being managed. This is why zero commission settles only one narrow question. It may tell Elena that a stated commission does not apply to a particular trade. It does not prove that the account, the investment, or the advice is free. She opens the fee schedule instead of trusting the headline beside the trade button. Then she writes down 4 categories: account charges, investment expenses, advisory costs, if any, and expected tax treatment. She is not trying to predict every future bill. She is refusing to mistake a gross balance for a personal result. A clean illustration shows how much that distinction can matter. Suppose Elena contributes $500 at the end of every month for 20 years. At an assumed 6% annual return with monthly compounding, which is never guaranteed, the account would grow to about $231,020. She would have contributed $120,000, leaving about $111,020 as investment growth in the illustration. Now, change only one assumption. If the net return after costs were 5% instead of 6%, with the same $500 monthly contribution and the same 20-year period, the ending value would be about $205,517. That is roughly $25,500 less. This is an illustration, not a forecast. Both calculations assume uninterrupted monthly contributions, constant returns, no withdrawals, and no margin borrowing. They exclude taxes and inflation. The 1 percentage point difference is hypothetical. It shows sensitivity, not the actual cost of any specific account or investment. But the lesson is concrete. A small annual drag can become a large gap when it repeats for 20 years. The app may celebrate the gross return. Elena's life runs on the net result. So the useful performance question is not, how much did the account earn? It is, how much value remained after every layer took its share? That leads directly to rule number 6. Money can be easy to reach and still be unsafe for a fixed obligation. The strongest case for a taxable brokerage account is flexibility. Elena may be able to sell investments and request cash without waiting for retirement age. For a goal that does not fit neatly inside a retirement account, that access can be valuable. But the sell button does not guarantee the amount she will receive. The missing variable is the market value on the date the money is needed. Suppose Elena expects to need $10,000 for a planned move in March. If that money is invested and the account is down when March arrives, the calendar makes the decision for her. She can sell at the available value, delay the move, reduce the plan, or find another source of cash. The account may be operationally liquid, but the goal is financially exposed. That is the difference between access and stability. I can sell it answers how money might be reached. It does not answer what the asset will be worth, whether the sale creates a gain or loss, whether taxes may follow, or whether Elena chose the timing freely. This is why a volatile holding should not be treated as emergency cash merely because it can be sold. Emergency money has to work when the timing is bad. An investment account can place market risk and an urgent expense on the same day. Then Elena notices the words member SIPC and feels a little safer. That label matters, but not for the loss she is worried about. SIPC can play an important role when a SIPC member brokerage firm fails and customer cash or securities are missing, subject to its rules and legal limits. It doesn't ensure the market value of an investment. It does not reimburse Elena because a stock, bond, mutual fund, or exchange-traded fund fell. Its role addresses certain custody failures at the brokerage, not the ordinary investment risk inside the account. The word protection is carrying 2 different meanings. Protection when a brokerage fails is not protection when an investment falls. Elena adds 2 fields to her account record, the earliest date the money may be needed, and the decision she will make if the value is lower on that date. For the planned $10,000 move, she now has to decide whether a fixed obligation belongs in an asset with a changing value. That turns liquidity from a comforting word into a decision she can see. Elena can now explain the wrapper, the account type, the registration, the priority sequence, the cost stack, and the difference between accessible and stable money. One question remains: what exact job is this account supposed to perform in her life? That is rule number 7. Because an account without a named job eventually gets funded, invested, or emptied according to whatever feels urgent that month, the final rule turns all 6 mechanisms into one ownership map Elena can use before the next dollar moves. An account without a written job will eventually take orders from whatever feels urgent that month. That is rule number 7. Every brokerage account needs a purpose precise enough to guide the next decision. Elena is back at the kitchen table where this started. Her savings account is still there. Her workplace retirement plan is still there. Her brokerage account is still open. But the 3 screens no longer look like 3 versions of the same thing. She can finally see the jobs. Savings protects money that cannot wait for a market recovery. Retirement accounts serve long-term goals under their own tax and access rules. A taxable brokerage account can hold investments for a goal that needs more flexibility, but only after cash needs, debt costs, available benefits, taxes, time horizon, and market risk have been considered. The missing variable was never the balance. It was purpose. Without a named purpose, flexible money becomes vague money. It can be invested too aggressively for a near-term goal, left in cash for years without intention, pulled out for an impulse, or counted twice in 2 different plans. The account can do many things, so unless Elena chooses one job, whatever feels urgent next will choose for her. That is why she builds an account ownership map before moving another dollar. She starts with 1 row for every account she already owns. The first column is the institution. The second is the account name. Then she records the registration, the owner or owners, any beneficiary or transfer on death designation, whether a brokerage account is cash or margin, the fee model, and the basic tax treatment. Then she adds the 2 columns most dashboards leave out: access rule and purpose. The access rule answers a practical question. What has to happen before this money can be used? Cash in a bank account may be available under the bank's terms. An investment may have to be sold, settled, and transferred. A retirement account may have distribution rules and tax consequences. Elena does not need every legal detail in one sitting. She needs enough clarity to stop treating every balance as equally available. The purpose column has to be specific enough to change behavior. Build wealth is too vague. Every account could claim that job. A useful purpose sounds more like this: emergency liquidity, long-term retirement income, a home purchase several years away, or flexible investing for a goal with no fixed withdrawal date. The wording matters because the purpose determines the time horizon, and the time horizon limits how much uncertainty the money can safely carry. Elena's strongest objection is honest. What if I do not know the exact goal yet? Then uncertainty belongs on the map. She can write long-term flexible ownership, no planned withdrawal date, and assign a review date. That is more disciplined than inventing a goal or investing as though the money can never be needed. A plan is allowed to change. It becomes dangerous when nobody can explain what the current plan is. Now, the 7 rules fit on one page. Rule 1 separates the wrapper from the investment. Elena records both the account structure and what it actually holds. Rule 2 identifies cash or margin, so borrowing cannot hide behind a routine-looking setting. Rule 3 records the owner, beneficiary role, transfer on death designation, and trusted contact role without pretending those names carry the same authority. Rule 4 tests the next dollar against near-term cash needs, contractual costs, employer benefits, tax-advantaged options, time, and risk before the transfer happens. Rule 5 records the taxes and costs that stand between a gross return and usable value. Rule 6 separates access from stability, so a sell button is never mistaken for a guaranteed balance. Rule 7 gives the account 1 job and a date for reviewing whether that job still makes sense. This is where Elena stops asking, do I have the accounts a financially successful woman is supposed to have? That question keeps her comparing products, balances, and other people. She asks a better one. Can I explain what I own, why I own it, what it costs, and what choice it is meant to protect? That is the identity shift underneath this entire video. Wealth is not proven by how many accounts you open or how sophisticated the dashboard looks. It shows up in the quality of the choices those accounts allow you to make. A well-designed brokerage account may help turn surplus income into productive ownership. It may give a long-term goal more flexibility than a retirement-only structure. It may create a pool of assets that is documented in your name and connected to choices you care about. But the account is not the wealth. The wealth is the growing ability to say no without wrecking the rest of your life. No to a job that consumes more than it pays. No to remaining financially confused because someone else understands the paperwork. No to treating every available dollar as permission to take more risk. No to an account feature you cannot explain. That power begins with clarity, not bravado. You already knew a green balance could not be the whole story. Now you have the rules that explain what was missing. You do not need anyone's approval to read your own statement, question a setting, compare a fee, or decide that the next transfer should wait. The account interface gives you options. The map tells you which option serves your life. So make the next action small enough to finish today. Open one current account statement. Do not open a new account tonight. Start with what already exists. Write one row with the institution, account name, registration, owner, beneficiary, or transfer on death designation, cash or margin status, fees, tax treatment, access rule, and purpose. If one field is unclear, circle it. That circle becomes the next question you ask the firm, your tax professional, or a qualified legal professional when the issue requires one. Do not fill the blank with an assumption just because the statement looks official. Then add the rest of your accounts one row at a time. When the map is complete, look for the real gap. It may be a brokerage account. It may be more emergency cash, an unclaimed workplace benefit, a beneficiary update, a fee you never noticed, or a purpose that was never written down. The map does not force the answer. It removes the fog around it. If this helped you understand a rule that was never explained plainly, subscribe for the next one. This channel is not here to make money sound mysterious. It is here to give you the numbers, structures, and questions that increase your power to choose. Elena closes the 3 tabs. Nothing in her accounts changed that evening. No new investment was purchased, no balance jumped. But for the first time, she can point to each account and say what it does, who owns it, what could weaken it, and what decision it protects. That is not paperwork. That is ownership. They did not build this map for us, so we build our own.